Now, the Nigerian equities market kicked off the year on a high following a reform-driven 2023 as investors welcomed new fiscal and monetary policies, with new attractions in the fixed income market thinning out investors' interest in the equities market. Cordros says it expects a muted performance in the second half of this year. Ope Oluwa, research analyst at Cordros, joins me for a review and outlook for the stock market this year. Ope, thank you for joining us today.
Thank you for having me, Esther.
Well, the optimistic outlook that we saw following when the reforms kicked off sometime last year appears to be waning. I mean, talking to analysts in the last couple of months, there's been a question of how patient can investors be in terms of allowing a number of these reforms to take root and, get the economy off the ground. But talk to us about equities investors, how they're processing the current reforms, the strength of the reforms a couple of months, a year later, and how they see this turning the economy around.
Yes, well, thank you very much. As you rightly mentioned, we started the year quite positively, carrying on the positive momentum that we ended 2023 with the all-share index in January crossing the 100,000 mark, which is the highest, or hitting the highest point ever, then returning a gain of almost 40% in January also. We've seen the market, now change performance in terms of the kind of momentum that we've seen in the market has sort of dipped and was basically doused by the impact of some of those reforms that you mentioned now on this time around monetary policy side of things, and some on the fiscal policy side of things also, given the fact that we now have quite attractive yield levels, especially for short-term papers. And I mean, of course, you'd expect that in such situation, investors will most likely tilt towards a situation where they are trading in guaranteed, or so to say, guaranteed investments. So this is what we've seen typically happen or play out in the Nigerian market. So now investors are chasing the 26% average yield level in the short-term papers, and are now not looking at Nigerian equities. And amidst all this, Nigerian seekers, so to say, are sort of suffering from the impact of some of these reforms, which at the beginning or at the onset right now have been quite painful. So we speak about the, FX devaluation, quite specifically, steep devaluation last year, and that one in January. We've seen consequently reforms by the CBN in terms of loosening and ensuring that all the gaps in that market are closed. So now the pressured FX market has been a key inhibiting factor to Nigerian companies, non-financial companies more specifically, most of them affecting their performance levels, or let me say corporate earnings. And this is also amidst the outlay of the highly inflationary environment, which has also affected costs and operating expenses. So that's how it has been. Investors have viewed this as quite, mixed, quite mixed perception.
That being said, according to your report, from a sectoral standpoint, the market was broadly positive. And it would appear that investors have taken shelter or seen as a safe haven some sector leaders across the sectors. I'm looking at the likes of Boa Cement, Boa Foods, Dangsem, Presco, Okomo Oil, and a few other big tickers. But what are your thoughts in terms of how profitable these stocks have been for investors, and if this will be the trend going into the second half of the year, taking shelter in this high dividend yield paying stocks, and of course looking at what these companies are doing behind the scenes to expand profitability, expand production, expand capacity, etc.
Yeah, so like you mentioned, these names you mentioned have put out very resilient numbers, which I would like to single out the agri names in that list. Presco, Como have been quite on the positive side in terms of the whole FX realignments and developments, basically in the sense that they take the benchmark prices, international prices. So this means that the higher rates translates to higher naira price points, which of course drive significant revenue accretion for these players. So we've seen resilient numbers from the other names here, the cement players, significant cost pressures that they faced, but it's been a rebound for them compared to the performance levels from 2023. And we expect much of this to remain the same for the rest of 2024. So for us, we think that whilst FX issues will still remain a key sticking point for non-financial companies, we expect to see better standalone performances in Q2. And by the time the earnings season for half year kicks in fully, we'll see numbers from these players or these companies rather showing lesser pressure in Q2, but still subdued numbers anyways. But we think that the companies or the names to look out most for which we count as winners are the banks. So the high interest rate environment and the high yields on investment securities are quite accretive for banks' earnings. And we expect to see substantial earnings, just as we saw in Q1 numbers, in subsequent quarters and even for the full year 2024. We expect to see something, obviously, performance that is as strong as Q1. So yeah, banks are quite positioned to do well, or best performing sector in the Nigerian market, whilst we expect a mixed performance across the non-financial companies.
Right. Just looking at some other parts of your note, you did note that domestic participants in stock market, you saw a bit of a decline. Can you just shed more light on that for us?
Yes. So, like I mentioned at the start of this conversation, given that Treasury papers now seem quite attractive at northwards of 20% levels in terms of auction rates and even overall yields, we've seen most of the domestic players, particularly institutionals, shift their focus from Nigerian equities or the equity market towards the fixed income market, as try to book the gains in this market, especially as they booked significant gains in January. And this also trickled down also to the corporate markets. We saw a significant number of commercial papers in Q1, in the first half of 2024 actually, and we've seen a significant portion of investors, both institutional and retail, also came to this issuances. So there's been, let me say, much of the interest has shifted from Nigerian equities and has moved towards fixed income.
All right, Ope, we'll leave it there. Thank you so much for sharing that with us today. We appreciate your time on the show. Ope Oluwa, research analyst at Cordros.